let us see the export finance or export credit. Okay. Now, what is export activity? It is nothing but goods and services are sent out of the country and foreign exchange is received into the country. See the types of exporters. One is manufacturer exporters. Second one is merchant exporters. Third one is deemed exporters and sub-suppliers. And status holders, export house, star export house, trading house, star trading house, premier trading house. What is export finance? Let us see. It is nothing but working capital finance to the exporter. How is it different from domestic finance? That we will understand here. Distinct stages of finance, dimension of risks and concessive credits, monitoring, ECGC cover, ECG means export credit guarantee cover, and benchmark lending norms, refinance, better profit for exporters, opportunity for bankers. Stages of export credit. One is pre-shipment and second one is post-shipment. Pre-shipment means from the date of receipt of order to the date of shipment. Post-shipment means from the date of shipment to the date of realization of the proceeds. So, these are the two stages in respect of export credit. Which is counterparty, bank or ECG or both. Then cost, the bank will provide funds and all these things. Or sometimes other credits also, FTPs. Then country, ECGC coverage will be available. And currency, bank will provide the currency. And procedures, we have to follow the RBI, FEMA, FTP, FEDI, all these people's guidelines we have to follow. Let us see the regulations and guidelines. One is foreign trade policy, it will be given every year. Then RBI directives, in respect of the RBI directives, old ones and amended ones are available. And in respect of the FEMA also, and FEDI rules, FEMA rules, UCPDC, URC, URR procedures. PDC, URC, URR procedures, ECGC guidelines, banks' internal guidelines, and export promotion councils, and GIC, that is marine insurance. All these regulations and guidelines we have to follow. What is UCPDC? Uniform Customs and Practices for Documentary Credits. That is called as UCPDC 600. And it contains some articles, around 39 or 40 articles will be there. And you have to be thorough with these articles. And URC. This is Uniform Rules for Collection. This is published by International Chamber of Commerce, circulated through the general brochure, and Indian Bank Association, the banks spread over the universe are members of the ICC. The international best practices have been pulled together and drafted in this document. This is called as URC, Uniform Rules for Collection. Please see the ICC Rules and Standards, UCPDC 600, Uniform Customs and Practice for Documentary Credits, URC 522, Uniform Rules for Collection, URR 725, Uniform Rules for Bank-to-Bank Reimbursement, and URDG 758, Uniform Rules for Demand Guarantees, INCOTERMS 2000, International Commercial Terms, ISBP 681, International Standard Banking Practice. Please note, ICC has formulated EURC, that is Electronic URC. So now recently they have formulated the guidelines, you can see in their ICC site also. Let us see the parties to a collection. Okay, one is importer, then exporter, then please see there is a relationship between the contract from the importer and exporter. Then afterwards a remitting bank, please see, and collecting bank, and documents will be sent to presenting bank, and presenting bank will give the documents to the importer, and importer he will make the payment to the presenting bank, please see, and this collecting bank in the foreign country they will collect, and after payment they will remit to the remitting bank, and remitting bank will pay to the exporter. This is procedure in respect of the URC. So what is URR? Uniform Rules for Bank to Bank Reimbursement. This is called as URR. So it will be updated as per the guidelines, ICC publication, and it contains around 17 articles applicable to bank reimbursement under documentary credits. This URR 725 they will call it as. Let us see the mechanics of documentary credit with reimbursement under URR. Please see it. Here importer and exporter, and in between there is a contract, please see it, and importer will ask issuing bank, and he opens the credit, please see it, and with the reimbursement instructions. Then this is called as letter of credit, you can see, and letter of credit will be sent to advising bank, and advising bank in turn will tell to the LC has been issued to the exporter. Then here this issuing bank or opening bank will make reimbursing bank will advise a reimbursement authorization. Then here exporter will ship the goods. Thereafter he will take the documents. Then the documents will be given to the negotiating bank, and he will take the payment from the negotiating bank. Then on the basis of LC and all these things, the negotiating bank will take the amount from the reimbursing bank by reimbursement claim. Please see it. Then the payment will be made to the negotiating bank. Then the negotiating bank will send the documents to the issuing bank or opening bank, and the opening bank will ask the importer to make the payment. Then they will give the document to the importer. Thereafter funds nostro account will be created in the issuing reimbursement bank, and here the importer will take the documents and take the goods. So this is about the mechanics of documentary credit with reimbursement. Let's see the appraisal of export credit. Here no compromise, repeat, no compromise on viability and integrity, number one. And then we have to see the exporter's capacity, timely delivery of the export goods, and technology what he is using, and management and expertise. All these things we have to study. And it should be need based, turnover and cost of inputs, and opinion report on buyer, and political, regulatory, financial condition of the importing country. If it is some other countries where there are a lot of disturbances, it is very difficult to export the goods to that country. Then acceptability of the LC opening bank and LC conditions. So all these things you have to do in the appraisal of export credit. Now let us see the appraisal of export credit RBI guidelines. Time norms for sanction, online credit, limits should continue uninterrupted in case of delay in renewal, and peak non-peak credits for seasonal commodities. That is also you have to ensure. Peak level and non-peak level you have to mention, and interchangeability in pre and post shipment facilities, and term loan requirements for modernization, etc. Here you have to assess even term loan requirement also. Not be denied merely on collateral security consideration, because we have to give more importance for the export finance. Merely we should not deny on non-availability of the collateral security. The assessment will be same as working capital assessment. Okay, you can see in my previous videos also about the working capital assessment. Let's see the assessment. Same lines as working capital assessments and export packing credit. Just like that, you have to calculate export sales estimated projected less estimated profit, export sales after deduction of profit, average export sales per month, average period for which EPC runs, that is export packing credit runs. Here inventory holding in number of days in case of units 100% exports. If the unit has domestic sales also, minus export production, inventory holdings levels to be arrived at in discussion with the borrower. Then average period for which EPC runs 3 1/4 month. Then EPC required, that is export packing credit required 5.17, 5.69. But EPC limit requested by the company, it is only 5 crores. So straight away you can recommend the EPC limit as 5 crores. Let us see the pre-shipment finance products. One is export packing credit. Then advances against checks, drafts received as advance payment. Then advances against government incentives also we can allow. Then what are the other facilities? Bid bond, advance payment, performance guarantees, and LCs for input imports, back-to-back LCs, arranging line of credit in buyer's country if the contract involves work to be done in the buyer country. So that we have to see. These are the pre-shipment finance products. The export packing credit may be in rupees or PCFC. So in foreign currency also. Packing credit, foreign currency. Let us see the windows of packing credit. Order to order basis, number 1. Then running account, we will discuss afterwards. Then PC for export of goods meant for exhibition and sale. And sharing of export packing credit between the merchant and manufacturer. Inland LC system for suppliers, and PCFC, that is foreign currency. Okay. Now let us see what is running account. It should be commodity wise for each exporter. It should be there. Please note it. Only for exporters with good track record. Automatic for EPZ and SEZ units, and monthly statement of LC's export orders in hand. Within 1 month you have to obtain, and it should not be available for sub-suppliers. Please note it. It should not be available for sub-suppliers. And PC availment not a precondition to liquidate. Okay, PC means packing credit. And advances need not be adjusted. Other advances or FIFO advances need not be adjusted with export bills of same transaction, subject to not outstanding more than the stipulated period. That is most important. Okay. Whether existing EPC running account or outstandings of the exporters in rupees can be converted into PCFC, that is packing credit foreign currency. Okay, whether we can do it, tell me. Let us see the PCFC, that is pre-shipment credit in foreign currency. Within the sanctioned EPC limits, export packing credit limits, and 4 designated currencies: US dollars, Great British pound, euro, and Japanese yen. Conversion of EPC to PCFC not allowed. Export to packing credit cannot be done in pre-shipment credit in foreign currency. And funds angle, it should be clear. And sharing of PCFC allowed. And cross currency drawals permitted. And partly rupee, partly foreign currency permitted. And rate as per the LIBOR. Okay. And PCF is, that is pre-shipment credit in foreign currency, not adjusted within 360 days to be crystallized at current TT selling rates. That is most important. Let us see the rules relating to packing credit. Sharing of EPC between merchant and manufacturer and sub-suppliers. Okay, EPC means export packing credit. And substitution of commodity order buyer purely based on commercial necessity. That is most important. And end use to be ensured. No question of any relaxation here. End use to be ensured. Pay order favoring suppliers wherever possible. To be repaid on shipment, normally within 270 days, not more than 1 year. Okay. And packing credit in designated foreign currency can also be given. Okay. So these are the rules relating to packing credit. Higher rate to be charged if more than 270 days, but less than 360 days only for the additional 90 days. Beyond 360 days, no concessional interest. Please note it. Normal interest plus penal interest to be levied. If no export takes place, normal rate plus penal interest. Suppose there is no export but you have availed the facility, then it will be normal interest plus penal interest. Rules relating to liquidation of EPC or PCFC. Advance remittances, export bills negotiated, purchased, discounted, and proceeds of duly drawback entitlements. To be repaid depending on seasonality, working capital cycle, in any case not exceeding 360 days, that is 1 year. PCFC, that is packing credit in foreign currency for deemed exports, should be closed by EBR within 30 days. EBR means this scheme is formulated by Reserve Bank of India. Here EBR means a rediscounting of export bills abroad scheme. So these are a lot of guidelines are available. Okay. Let us see the post-shipment finance. any credit provided to exporter from date of extending credit after shipment of goods to the date of realization of export proceeds tied over waiting period. It is called as post-shipment credit. It is to finance export receivables. Finance against evidence of shipping document, that is shipment of export goods. All these things we have to take in respect of post-shipment finance. What are the post-shipment finance windows? Negotiation of documents under LC, purchase at discount of non-LC documents, advances against bills sent on collection, advances against export sent on consignment, advances against government incentives, advances against undrawn balances, retention money, and rediscounting of export bills abroad, EBR. Post-shipment finance. Separate limits for LC, non-LC bills. Opinion reports on overseas buyers, buyer-wise limit, and D&B reports also to be obtained. Correspondent arrangements and country risk factors also to be taken. Standing of LC opening bank. Negotiation of export documents as per UCPDC, LC, those UCPDC guidelines. And negotiation with discrepancy to have indemnity. And purchase or discount of non-LC bills, what we have to do? Documents should be in accordance with the firm order or sales contract. Clear instructions of drawer in case of non-acceptance or non-payment. So all these things we have to take into post-shipment finance. Assessment of FBD. Here export sales estimated projected, like that you have to take, and average export sales per month, and estimated percentage of sales under non-LC, and usage period of bills, and FBD non-LC required, and FBD non-LC limit requested by the company, and recommended FBD limit. Here the requested company is less than the FBC non-LC required. That's why we are fixing 4.5 crores. EBR. All export bills on account of which PCFC has earlier been sanctioned should be discounted under EBR, and such bills cannot be sent on collection basis. All exporters are eligible to cover their bills drawn under the letter of credits, non-credit bills under sanctioned limits in the bill rediscounting scheme. Forward contracts can be booked to the extent to which it is not covered under PCFC, packing credit in foreign currency. EBR is offered for a maximum period of 180 days, inclusive of grace and transit periods, except where a customer can draw bills beyond 180 days. So this is about the EBR scheme. Let us see the rediscounting of export bills abroad, that is EBR scheme. Post-shipment finance at internationally competitive interest rate and effective cost to exporters not to exceed 2% over 6 months DIBOR. All export bills, demand and usage are eligible under EBR scheme. Now see verification of bill of lading. Bill of lading is nothing but here how they have transported the goods and the evidence of transporting the goods by the exporter to the importer. The original invoice and packing list certified by the customs authorities to be scrutinized and a copy of the above documents duly recording the fact of scrutiny by the bank staff to be retained at the branch. Number 1. Please note it. This is very important. The copy of shipping bill certified by the customs authorities to be scrutinized and a copy of the above documents duly recording the fact of scrutiny by the bank staff also be to be retained at the branch. If necessary, in cases of any doubt or suspicion, or a reference can be made to the customs department quoting the shipping bill number and date to confirm the genuineness of the bill of lading and or of their endorsement on the invoice and packing list. Okay, this is very important. Please note, a reference to customs for confirmation should be only in exceptional cases where there are some grounds of doubt and not as a matter of routine. While negotiating the export bills, a notice of the bank's interest in the goods covered by the bills of lading have to be sent on forms specified to the shipping company concerned by the negotiating branch as laid down in the manual of advances and loans of the concerned bank. Let us see the crystallization of unpaid export bills. What we have to see here. The branch is satisfied that the exporter has not been able to release export proceeds in spite of best efforts and for reasons beyond his control. Number 1. The exporter has submitted a declaration that he will realize the proceeds during the extended period. The hedging practice, booking of forward contract, etc., and the conduct of the account should be satisfactory. Crystallization history of the exporter and percentage of overdue export bills, and the exporter has not been caution list of unpaid export bills. Authorized dealers are free to decide on the period for crystallization, which may be linked to risk factors like credit perceptions of different type of export clients, operational aspects. Okay, apply the TT selling rate ruling on the date of crystallization. So it is change from bank to bank, that is exchange difference arising out of the crystallization to be recovered from or passed on to the customer. These are the guidelines in respect of export finance. Thank you.